A lease is a right to use an asset, such as property, plant, and equipment. There are two parties involved in a lease. There's a lessee, which is the party that's going to be using the asset, and the lessor, which is the original owner of the underlying asset. So a quick diagram to show the aerial view of what's happening. Here's the lessee, which is using the underlying asset. And in exchange, the lessee will be making lease payments to the lessor for the right to use that asset. So let's give some numbers to this illustration. Suppose that the lease allows the lessee to use the underlying asset for 10 years at lease payments of $5,000 a year. And if we assume that the lessee's discount rate is 8%, we can easily discount the $5,000 over the 10 years using the input of values, and we can calculate what the present value of that lease agreement is. So 10 payments of $5,000 each year is the equivalent of $33,550 today. So now, of course, we're going to look and see what the impact of the lease will be on the financial statements of both parties. Let's first start off with the lessee's financial statements. And for both US and IFRS, here's the rule. For all leases, the lessee, once again, the person or the party that's using the asset, must recognize it on the balance sheet. So in the asset section, the lessee would have a line item called right of use asset. So when we see right of use, it means that that asset that the lessee has, it's being leased rather than owned. And of course, on the liability section, they would have a line item called lease payable. That just indicates to the reader that the lessee is obligated to make future lease payments, much like a loan. Now, this is the equivalent of the lessee issuing a loan or liability of $33,550 and then using the proceeds to buy an asset that's worth $33,550. Okay, so even though economically the lessee, or I should say, even though technically the lessee is not buying the asset, from an accounting point of view, it's treated as if the lessee did indeed buy the asset. So therefore, at the inception of the lease on the balance sheet, the lessee would record an asset and liability which is equal to the same amount. And that would be the present value of lease payments of $33,550. So once again, it's worth reminding that even though technically the lessee did not buy the asset, from an accounting point of view, because the lessee is still using the asset, the accountant is saying, we really don't care whether you bought it or whether you leased it. The fact is that you are using this asset, and therefore you have to report it on your balance sheet. And that's why they treat it as if they bought the asset, even though the lessee never actually paid $33,550 for the asset upfront. Instead, the $33,550 represents the present value of the future lease payments that the lessee has to make. Okay. Now, after inception, in other words, after we've treated it as if the lessee just bought an asset, let's see what happens to the financial statements. And so here's where IFRS and US differ a little bit. So for IFRS, again, we're talking from the lessee's point of view. Here's the balance sheet. As we indicated before, the lessee has to report the right of use asset and the lease payable. Well, that's going to have repercussions on the income statement. So for example, if the lessee is carrying an asset, then it would have to depreciate it. So it recognizes depreciation expense, again, just as if it had actually purchased this asset. On the other hand, because the lessee is deemed to have issued a loan in order to purchase the asset, well, anytime a company has a loan, it's going to have interest costs to go with it. Now, the third financial statement is a statement of cash flow, and the lease payment is viewed as follows. The principal repayment is regarded as a financing item, and the interest payment, according to IFRS, may either be treated as operating cash flow or financing cash flow. So once again, if you look at these financial statements right here, it looks exactly identical as if the lessee had purchased the asset rather than leasing it. So again, from an accounting point of view, it really doesn't matter to the lessee if they're leasing the asset or purchasing the asset. The accounting treatment is the exact same. Once again, you depreciate the asset as if it's yours. You pay the interest as if you borrowed the money in order to buy the asset. And these lease payments are regarded as repayment of the loan. So once again, these lease payments are considered as repayment of the loan that you took out to buy the asset. So of course, when you're repaying a loan, you're going to have two components, the principal and the interest. Okay. Now let's have a look and see what the U.S. accounting standards have for the lessee. U.S. has two options for the lessee. The lease may either be treated as a finance lease, FL for short, and this is used when the lessee is the beneficial owner. In other words, the lessee bears most of the underlying assets, risk, and return. In that case, U.S. and IFRS are the same. So once again, if the lessee is viewed as having essentially or effectively purchased the asset, then it's regarded as a financing item. In other words, the lessee borrowed money from the lessor and then used that money to buy the asset. So when the risks and returns have sufficiently transferred to the lessee, they might as well have purchased the asset. So if US and IFRS are largely the same, then let's go have a look and see what the impact on the balance sheet and or the financial statements would be. So you could see that the balance sheet under US is exactly identical to IFRS, where the lessee has to carry the assets and report the loan. And similarly, the income statement is exactly identical to IFRS, where the asset is depreciated and the loan incurs interest expense. However, the only difference between US and IFRS when this is treated as a finance lease is in the statement of cash flow. Remember what we said, these lease payments are treated as principal and interest payments. The principal is treated as CFF or financing under US and IFRS. However, when it comes to interest, US only allows interest to be regarded as operating, whereas where we saw previously, here we go, under IFRS, the company can treat the interest payment either as operating or financing. So that is the only difference between US and IFRS from the lessee's point of view when it comes to finance lease accounting method. IFRS allows two options for interest, whereas US GAAP only allows one, and that's CFO, okay? Now, the second accounting method that US GAAP allows for the lessee is operating lease right there. And this is used when the lessee is not deemed as a beneficial owner. In other words, it does not bear most of the assets, risk, and return. Nevertheless, the asset and the liability is exactly identical to what it would have been under the finance lease method. In other words, the lessee still has to report the asset that they're using, and they still have to report their obligation on the lease. In other words, they've promised to make these future payments. However, it's the income statement that's going to look different. Rather than reporting depreciation expense on the asset and interest expense on the lease, the company would just report lease expense. And what is lease expense? Where lease expense is the straight line allocation of total lease cost over its term. So basically, you would add up all the lease payments over the 10 years. So that would have been, we said 10 years, 5,000, so that'd be 50,000. And we would actually expense that over the life of the asset, or over the term of the lease, I should say, okay? And on the statement of cash flow, the entire lease payment would be operating. And that's a little bit different than finance lease, because if you looked at finance lease, which is right here, the statement of cash flow under finance lease, we actually split the lease payment into principal, which was CFF, and interest, which was operating. But under operating lease, the entire lease payment would be CFO. So therefore, if the lessee is using the operating lease method, their CFO would be severely depressed, because the entire lease payment, not just the interest, but principal plus interest, is used as an operating cash outflow. So the whole amount would drop, the whole CFO amount would drop by the lease payment. Now, there is always an exception to the rule, and on this, US and IFRS are the same. The exception is as follows. If the lease term is very short, or the underlying asset has very low value, I guess the logic is it's really not worth for the any of these parties to do up a whole financial statement like we saw previously. Instead, on the balance sheet, the company does not report the asset or the liability. In effect, then, the lease is viewed as a rental arrangement. So if the lease is so short-term, like maybe less than a year, then it's not worth carrying that asset on your balance sheet, and it's not worth reporting your lease payment on the liability section. Instead, it's just viewed as rent. And if you're renting something, you don't own it. And that's the way it's presented on the financial statements. On the income statement, the lease payment is just treated as a one-line item, rent expense. So unlike previously in finance lease, where the lease payment was split into depreciation expense on the asset and interest expense on the loan, so there you had two line items. Here you just have one line item, and it's going to be rent expense. And then finally, on the statement of cash flow, right there, the entire lease payment is regarded as operating. Obviously, rent is an operating item. Okay. Now, it's very important to note that everything we discussed up until this point has been from the lessee's point of view. That's the party that's using the asset. Now we're going to look at the other party, the lessor. This is the party that originally owned the asset and is just lending it out. Okay. And again, the way we're going to break this down is by how IFRS treats it and how US GAAP treats it. So IFRS has two options for the lessor. Finance lease, same definition as before. It's as if the lessor sold the underlying asset to the lessee in exchange for the debt issued by the lessee. So we're going to look at this with a visual, with a framework. So here's the lessor. That's the person that originally owned the asset. And here's and there's the lessee, which is a party that's using the asset. So the way this transaction is viewed, even though this didn't actually happen, from an accounting point of view, this is the way it's actually treated. So basically, it all starts off with the lessee needing the asset. So what do? They sell a bond, and it's right there. So they're selling the bond. Guess to who? The lessor. So in exchange, the lessor gives money for the bond. So from the lessee's point of view, they're borrowing. So here's the lessee. You could see that the cash flow is coming in. So they're actually borrowing. On the other hand, from the lessor's point of view, they're actually viewed as buying a bond, right? Now let's trace this money. So once the lessee raises the cash by issuing a bond, that cash is then being used to buy the property, plant, and equipment. It's right there. So in effect, the lessee's taking that money, it's right there, and paying it back to the lessor, and then buying the property, plant, and equipment from the lessor. Now, even though this is not actually what happened, we're going to do the accounting as if this is what indeed happened. So let's go have a look and see what the impact is going to be on the financial statements. And here's the lessor. So basically what you see in these financial statements reflects what's happening in the diagram. Let's have a look. So on the balance sheet, in the asset section, we're going to remove the book value or the cost of the PPE, and it's right there. If you see there, it's viewed as if the lessor sold their asset. On the other hand, again, we could see from the diagram that the lessor bought a bond that was issued by the lessee. So if we go back to our balance sheet right there, so what's included in the lessor's balance sheet? They would include a line item called lease receivable, and it's basically the present value lease payment, which is really what the value of the bond is. In other words, we're assuming that the lessee issued a bond that was equal to the present value of the lease payments. So basically, the lessor is reporting as if they bought a bond, which they just call lease receivable. At the same time, though, they would also include the residual value of the asset itself. And why is that? Because the lessor will get the asset back after the lease term expires. So, in other words, the lessor has not completely given up the asset. They've given up most of its useful economic value, but when they get the asset back at the end of the lease term, it'll still have some value, and that's the amount that they would record. Okay. Now, from the lessee's point of view, again, the impact on the balance sheet will be an exact reflection of what we see in the diagram above it. On the asset section, you could see that the lessee has bought a bond. Has bought the asset, which is referred to as right of use, and they sold the bond right there, and therefore on the liability section, they would include the value of that debt. Okay. Now, what would the impact be on the lessor's income statement? Revenue would be the value of the PPE, which is the present value of the lease payments. Okay, and the cost would be the book value of the PPE itself. Now, I know this may seem a little confusing because we got PPE there and PPE here, but this is how retailers make their money. They buy something at cost and they sell it at retail value. So they're not the same thing. Obviously, there's a profit margin built in to the lease itself. Okay. Now, it's also important to note that this entry into the income statement would occur at inception of the lease, so day one. In other words, the lease is viewed as a sale of asset. So that's a one-time transaction, sale of an asset. So the lessor records the sales price of the asset and also records the cost of that asset which was sold. Okay. So what happens after inception? After the first day of the lease, the lessor will recognize interest income on the bond, which is the debt owed by the lessee. So we have to remember that in a finance lease, the lessor is holding an IOU or debt that's issued by the lessee. And as long as you're holding debt, you're going to be earning interest income. So what's the impact on the statement of cash flow, which is the third financial statement? Just a tip here. The lessor bought the bond, whereas the lessee issued the bond. Let's just go to our diagram very quickly again. And here's that transaction that we're referring to. If you look at that transaction, the lessor is buying the bond, whereas the lessee is issuing the bond. And why is that important? Well, each of those activities is categorized differently. If you're buying a bond, it's considered as investing. So from the lessor's point of view, that bond transaction is an investment. However, when you issue a bond or issue debt, that's viewed as financing activity. So from the lessee's point of view, it's regarded as financing cash flow. Okay. So on the lessor statement of cash flow, the principal payment is investing, as we discussed right there. Basically, it's viewed as if the lessor is getting their principal back on the bond that they had purchased. And because this is, we're still talking about IFRS, any interest income earned is regarded as operating or investing, because these interest cash flows are coming from an investing activity. So again, IFRS always gives more than one choice when it comes to interest and dividends. Okay. Now, the second method that IFRS permits is to the lessor, let's be specific, is the operating lease method. And here the lease is viewed as a rental agreement. So the impact on the lessor's financial statements are as follows. On the balance sheet, they would actually retain the cost or the book value of the PPE as an asset. And what's the logic there? If this was a rental agreement, then the lessor still owns the asset. In other words, the asset was never really transferred to the lessee. The lessee is just renting it. So the lessor would still be carrying the asset. And on the income statement, the lessor would report a revenue equal to the lease payments. Remember, it's rent. So the entire lease payment is regarded as rent. And because they're still holding the asset, the lessor has to depreciate it. So they would recognize the depreciation expense, okay? And on the statement of cash flow, the entire lease payment received by the lessor would be regarded as operating. Of course, it's rent. Whether you are, the person renting or the person collecting the rent, it's always viewed as operating. Now let's have a look at how US GAAP applies to lessors. The first type of accounting method is sales type lease, and this occurs if the risk return sufficiently transferred to the lessee and the collection of lease payment is probable. Then the US treatment under sales type lease is very, very similar to the finance lease method under IFRS. So if that's the case, let's go see what the impact would be in the lessor's balance sheet under sales type lease. Again, it's deemed as a sale, so the lessor would remove the cost of the PPE because it's sold, right? But then they would include the loan receivable or the lease receivable plus the expected residual value of the PPE at the end of the lease term right there, okay? So now let's look at what the impact would be on the lessor's income statement under sales type lease. Again, we said this is very similar to IFRS finance lease. So on the income statement at inception, it's deemed as a sale. It's deemed as a sale. So for revenue, you recognize the retail value of the lease, which is the present value of the lease payments, and for cost of goods sold, whatever the book value of that asset was. And then post inception, the lessor's just holding a bond, and therefore they would earn interest income. Okay. However, when it comes to statement of cash flow, there is a slight variation between US and IFRS. Once again, this comes back to IFRS giving you options when it comes to interest. So the principal payment, both US and IFRS treat it as an investing activity because remember the lessor is viewed as having purchased the bond. However, the interest payments, US only allows CFO, whereas IFRS allows CFO or investing cash flow. Now, the second option US allows for the lessor is as follows. If the risk return not fully transferred to the lessee or the collection is doubtful, the US has two alternatives. it can allow the lessor to use operating lease, and the operating lease method under US is exactly identical to the operating lease method under IFRS. Essentially, it's viewed as a rental agreement, and therefore the lessor still has to record the asset, it still has to report depreciation on it. It's not viewed as a sale. Why? Well, because the risk returns have not been transferred, and if the collection is doubtful, then you're never going to collect that sale. So no accountant would allow this transaction to be reported as a sale. The other option is direct financing lease. And over here, the lease term is long, but still not regarded as sufficient transfer of risk and return to the lessee. So what would the impact be on the lessor's financial statements under direct finance lease? Balance sheet asset section. So they would remove the book value of the PPE, and they would include the loan receivable. So this is kind of similar to the finance lease method we saw before. And on the income statement, here's where the difference occurs. No profit is realized at the inception of the lease. And the tip there, and something we discussed before, if risk and return on an underlying asset is not transferred to the customer, it is not deemed a sale. So therefore, the lessor will only realize the interest income on the underlying debt. So if we look at the income statement before, right there, where under finance lease, they were allowed to record it as a sale. Under the direct finance lease, there we go. At inception, no such thing. You are not allowed to recognize revenue or the cost of the goods sold, okay? Instead, you're only allowed to recognize the interest income on the loan that the lessor holds, okay? And on the statement of cash flow for the lessor, the lease payments, same as before. All principal is viewed as investing. The interest is CFO. So the tip here is that under direct financing lease, which only US GAAP allows, the lessor viewed as a bank, not as a manufacturer that sells equipment. And why is that an important tip? Well, if it's viewed as a bank, its financial statements will look like that of a bank. In other words, on the balance sheet, the lessor will only have loan receivable. And on the income statement, it would only have interest income. So no profit upon sale. There is no sale. And for the lease payments, the principal is viewed as investing, whereas the interest is viewed as operating.